Marty, could you do a brief introduction about who you are and what you do?
Absolutely. I'm Mardi Kari. I'm the president of Arcstone Financial, a company located in Los Angeles.
Yeah,
And
yeah.
we run a mortgage banking firm. We're a direct lender, and we have all the products from Fannie, Freddie Mac, and all the way to jumbos and alternative lending options as well.
Yeah, the main reason we're having this Zoom call is because on Wednesday, the Fed raised the rate by the 75 basis point. How is it going to affect any home buyers in the market right now?
Well, that's actually a good thing that they did that, Cindy, because that showed that they're doing the responsible thing, and they caused the markets to actually be a little bit more stable, and it caused for the rates to go down.
Oh, so the rate is actually down instead of going up right now?
Absolutely, it's stabilized, and it's actually the bond markets are reacting favorably, and it's causing for the interest rates to go down.
Can you give us an example? For instance, at 30 years fixed mortgage, 20% down, conforming loan limit in Los Angeles, decent credit score and debt to income ratio. What is the approximate interest rate?
I mean, they're still not to the old rates, but they're into the fours now. So the high fours is what the
High
interest rates are.
fours.
Mhm.
Oh, it's actually not too bad because last week I thought it was still in the mid five, isn't it?
It was actually, yeah.
Okay. So, um, with the Fed rate increase and the GDP, I heard it actually fell by 0.9%. So is it going to affect the housing development? I mean, the supply side of the housing.
Well, when the GDP drops, basically what it's indicating is that the the economy is shrinking. So yes, it could potentially do that. It could make it where companies are going to shrink as well too. So there's some downsides with the GDP shrinking, and it could cause things like unemployment, things of that nature. But this is the right thing to do, because what happens is when you have a GTB that's shrinking, that you're in a recessionary market. And what will happen is, to solve that, you're going to have to drop interest rates to induce more people to buy things, and for corporations to be able to borrow more money and increase their staff up again and grow the economy once more. So it's like a cycle that we're in, because we're in an inflationary market. Rates had to go up to slow things down a little bit, and then what we'll do is we'll ease the rates back down to get to a balance, because at one point it was going up too fast.
But my problem is in Los Angeles, we always have supply problem. If, the housing development is slowing down, which means that we still will not see a huge price drop in the housing market in Los Angeles. So, which means we'll never solve the housing issues here then.
Well, listen, it's going to be a natural solution. As rates are up, people cannot qualify for as much as they were able to before. And sellers will get a reality check that values are not going to increase 10 to 30% annually, which is abnormal. So it's not going to happen overnight, but it's definitely going to adjust down a little bit. But you're right, the supply is not going to be enough, because based on the one basic thing, that population is even more than what the supply has in Los Angeles at this point in time. So that is going to be holding prices stable, I think, and the demand will always be there. It just might not be as hot as it was, which was an abnormal market before. I mean, as you know, when a property came on the market, whether it was a good property or a bad property, it had 20 offers on it. I mean, that was like people were at, it was like communist Russia. That felt like they were at the food lines or something like that. But now it's going to become a little bit more natural. Instead of having 20 people, you'll probably have 4, 5 people writing that are qualified and are solid buyers, and it'll stabilize the market for all of us, because it was an abnormal inflation going on at that point in time. So, and it wasn't making sense. It's not normal for things to go up 30% annually.
I know you do commercial and construction loans too. Do you see a slowdown in construction loans?
Absolutely. Yeah. Right now, people are a little bit more, methodical about what they're doing, because construction loans can also involve builders who perhaps want to see a fast return on their money as well too. So that's, causing for people to take a pause. And also construction loans are not as liquid in the secondary market. What I mean by that is that those loans cannot be securitized on Wall Street as easily as a primary home with all the amenities already in there. So that those investors are also pulling back a little bit and they're taking a pause. So it's making the market, the availability of lending on construction loans not as easy at the moment in time. So it's not terrible, I'm telling you that, but it was not as aggressive as it was before.
So in today's environment, do you still advise, buyer to buy right now, or they should wait until 2023?
Oh no, I would 100% still advise to buy, because interest rates fluctuate. We go down on interest rates, we go up on interest rates. Right now, it's, as we saw, we're entering a recessionary market and the rates are going to go down. And what happens when rates go down? More buyers come into the equation again, and values will sustain and or maybe increase again a little bit more. We thought maybe that values are going to go down, but I think it will be stabilizing or maybe going up again. Right now is a great time because there's not as many people interested, and generally most people make their wealth in a time of uncertainty. So right now it's a little uncertain, and most wealthy people have made their wealth in a time of uncertainty is what I would say. So
yeah, I know you mentioned the word recession. So do you really think that we're entering recession, or we are already in recession?
I'm an econ major and we're already in recession. Yes.
Because I follow a lot of news. They're saying that we may not be in a recession because, like, we still have jobs, people are still buying. So what do you think?
I mean, just the definition of a recession is a 2 quarters of reduced GDPs, and so that's just the definition of it. I definitely think we're entering a recessionary market as well, just because that's just a trend at the moment of what we're seeing. So I anticipate that that's going to be resolved by interest rates at this point.
All right. Thank you so much for providing this useful
Of course.
information for my client and the general public. So hopefully, we will do this more often to educate the buyers. And if you have any questions regarding any loan program, please reach out to Marty. So I'll be posting this video on Instagram and YouTube. So thank you. Thank you so much, Marty.
My advice is call your trusted agent and have conversations, because your agent is going to have way more knowledge than your uncles or your cousins and whatnot. So, everybody has got licenses, and we all stay in tune with the economy with one another. So definitely I would advise any buyer to reach out, or any investor reach out to their agents today.
All right. Thank you, and have a good weekend. We'll talk again soon.
Thank you again. Have a good rest of the day.
Bye.
Bye-bye.